Now, Paul, we've talked a lot about the benefits and kind of the pros to these kind of plans. So sometimes I'll even get a client who will say, okay, these plans seem a little bit too good to be true. What are the negatives that I should consider? So obviously, there are a couple of negatives that every business owner should consider before setting up these plans. Can we talk a little bit more about those downsides or disadvantages?
Yeah, absolutely. And you know this, Zach, when we do initial call, I mean, we don't set up a plan with any client, off the street without talking to them. When we do initial call, we always tell them the downsides and the disadvantages. At Empyrean, we're not going to sell you a plan if it's not a good fit, because if it's not a good fit, you're going to have a lot of questions, concerns, you're going to want to terminate. It's going to take up a lot of our time and your time. So we want to make sure they're a good fit for you. Everybody's well aware typically of the large tax deductible contributions and so forth, but three main downsides or disadvantages to these plans that we want to make sure you're aware of. First of all, they are a permanent plan design. What does this mean? Well, you don't have to have the plan forever, but you want to have the plans for at least a few years. Some people say 3, some people say fine. I would generally say 3 years is fine, but you go into these plans with long-term intent, and you assume you're going to have this plan forever, but we know life changes. Something happens. You take a W-2 job down the road, you retire, whatever the situation is. And so, you're going to probably need to terminate the plan and at some point, and you're not going to hold on to it, to annuitize the revenue stream through the income stream through retirement. So you go into them with a permanent ongoing plan design with ongoing plan requirements. And if something changes, you get out of it. So just assume you need to have the plan at least a few years, 3 years, in place. Okay. That's number one. Now, number two, you're going to have mandatory contributions. 401k plans or defined contribution plans for that matter are elective. They're optional. You don't have to do them. Okay. Gives you some nice flexibility. If you're going to use money for whatever another purpose, and you don't want to fund, that's great. But these plans, as a general rule, you're going to have to fund them every year. How much? What is your minimum contribution? Tough to say, because it really depends on your situation and the plan design. Now, we can structure these plans with a custom design that's going to minimize kind of any sort of possible contribution you might need to make. Okay. So there are ways to limit that. And also there are a lot of times where people are very aggressive with these plans where they make very large contributions. And as a result of those, they become overfunded. So they might not have a minimum. Okay. So many situations, they don't have a mandatory minimum, but you want to go into them assuming you're going to have to make a contribution. Again, how much, it's tough to say, but 50 to 100 grand, maybe 100 is too high, but depends on the plan design. If that's something that's really a concern of yours, you could talk with Zach on how to structure it to make those minimums as low as possible. But needless to say, you want to assume while this plan is open, you're going to have to make a contribution. So you want to make sure you've got some adequate funds set aside. So that's really the second negative. The third one I would say is always fees. A lot of people are used to defined contribution plans, 401ks, where the fees are either, zero or a few $100 or something like that, rather nominal. These plans are going to cost you, $1,500 or so to set up, a couple $1,000s a year to administer. So a much higher fee structure. Realize those fees are going to be tax deductible. So, you're going to, if you're in a 45% tax bracket, you're going to save, almost half of that, in net when you record them on your tax return. But fees are definitely something you want to consider. And the fee structure is definitely higher just because of the actuary involvement. Our actuaries are going to do actuarial valuations, Schedule SBs. So the fees are going to be higher. I see people being sold these plans, I'm sure you do from time to time, Zach, where they're only getting contributions of 20, 30, 40 grand in. That typically doesn't make a lot of sense. Usually a 401k or a SEP is going to make a lot more sense in that situation because of the more flexible design, the higher costs associated with a DB plan. So that doesn't make a lot of sense. But I think most people find if you're going to put 100 grand into retirement, the higher fee structure, especially given the tax deductions of the fees and the contributions, our fees become immaterial at the end of the day. But again, that's a downside. People need to consider that. I don't know if you see any other downsides or disadvantages to these plans as speak to clients or as they bring them up to you, Zach?
Most often I just get, I would say concerns about the complexities of the plan and trying to understand all the nuances. And that's really why we're here. And each year we'll guide our clients through, what they can expect for their future contributions and how their contributions kind of work with their compensation. So it's really just it takes a little bit of extra time and attention to really, maintain these plans for our clients. But again, the far, benefits of the tax deductions and the amounts they can contribute towards their retirement far outweighs kind of the complexities and some of these other negatives that we just talked about.
Yeah. And to add to that, you're right. I could probably say number 4 downside is the added complexity. I mean, there are some people that want to understand every nuance of these plans. I've been involved in thousands of plans and been doing this for, 10, 15 years. 15 years ago, I started seeing my first plans. I learn something new every day, and I'm sure you do, Zach, when it comes to these. So, these plans are very complex. When you're given the plan document, there's a lot of involvement. And you're right. For someone who's doesn't want to take the time to understand, or maybe has struggles a little bit with more financial topics, you're absolutely right. Complexity alone might be a reason to not do them. But again, for the right person, they're a perfect fit. And we can typically dumb the plans down a bit to make sure they understand them enough to keep themselves from getting out of trouble. So hopefully
absolutely.
Hopefully that's a good summary of the downsides and the disadvantages.
No, absolutely. And a lot of our clients, they work with other tax professionals, CPAs, financial advisors who are helpful for them, and they'll just kind of pass on those duties to them. So really, it's just a matter of client preference. Obviously, these plans aren't cookie cutter or meant for everyone, but when they suit a particular client situation, they're just an absolute home run.
Yep, absolutely. Makes perfect sense. But definitely weigh the downsides or the disadvantages of these plans. And, you'll make a decision, if the plan's going to be good for you in your situation, So
absolutely. Perfect summary. Thanks, Paul.